Coming up in this show, I'm going to bring you my opening comments on the markets. Harvey has a trade idea for you in floor, looks bullish. Black Friday specials are here, and you can also give the gift of askSlim. Some great stuff we're going to show you, and I'll bring you my analysis on the stock market. First, we'll look at 10-year yields, which are a key to market projections, and then we'll look at the S&P analysis for the next few months.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward to what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market traded in a typical holiday week style, extending gains that we've seen now for 4 weeks, though on lower volume. Not that lower volume diminishes at all the huge upward vault that we have seen, with the S&P 500 gaining 11% off of its lows, and that regains almost all of the decline that we saw that took 13 weeks to lose. So it's clearly been a fantastic rally. Most of the gains this week came on Monday, and that happened as Microsoft led the tech stocks to the upside, lifting the NASDAQ, on news that OpenAI Sam Altman was jumping ship over to Microsoft. That actually proved incorrect because he went back, but the techs, they held their gains strongly, pretty much all week long. Well, except for maybe one exception. I'll tell you about that in a second. Tuesday, we saw the market move back. It gave some ground on some retail earnings, and retail stocks are really giving some warnings in here that they have a sense that the consumer may be strapped. Wednesday, stocks move up again, and that was into the Fed minutes, and the news really wasn't a surprise at all. They said they're data dependent, and that's kind of what we expected, mostly in agreement to move cautiously now. I've actually thought that they were done raising interest rates, and that might be the case. Though the interest rate market may have more to say about that, we'll look at that also coming up. But overall, we saw the market hold its gains, even though after the Fed minutes, it got a little bit rocky. Friday, well, we had an early close after being closed for Thanksgiving on Thursday. And of course, I want to wish all of you a wonderful Thanksgiving and holiday season coming up because we're all so grateful for you here. For those of you that have been students of the stock market and stock market history, you probably know that the Fed's reaction to the crash of 29 is blamed partially for the extent of the Great Depression. First, they stimulated like crazy in the Roaring '20s, and we had that big bubble that occurred. And then they sharply contracted the money supply after the crash. That was their response, thinking that was the right thing to do. I'm actually a really big fan of Game of Trades. He puts out some absolutely great stuff, and so I look at his stuff all the time, and occasionally I bring you a chart that he has published, and I want to bring that now. Since the great financial crisis, 2008 through 2022, the Fed went into wild printing. I mean, that strategy was essentially zero interest rate policy and QE that they just did more and more of. And then the government threw ridiculous amounts of money at the COVID pandemic. And that brought, as we saw, a big inflation and an everything bubble. Now, take a look at this slide I want to show you. And this is the M2 money supply since 1960. Now, like I said, they contracted the money supply very severely in the early part of the 30s, just after the market crashed in 29. And now what we see looking back to 1960, the steepest contraction in the money supply ever. This is really important. I'm glad that Game of Trades brought this out. I mean, it really speaks to what happens. You can see what happens when the money supply contracts right in here and here. You get these recessions, and some of them were quite deep. We know that the 70s were a lot of problems in there. And here you can see other recessions. These right over here you don't see much of a money supply contraction, maybe a little one right over here. But look at the size of this. This is just absolutely huge as the government is trying to correct the nonsense that they did for all of those years and trying to get normalized. So that's really an important statement, normalization. The interest rates now up around 5.25 to 5.5% are just now at the average of interest rates over many decades. So they have finally normalized, at least on interest rates, and their balance sheet is still extremely high. So I wanted to show you that. That does set up what could be a lot of trouble moving forward. And we see that the banks are not loaning out as much money and the consumer is very strapped. There's just a lot that is really going on right now. But the Fed, they're only going to cut rates if there's a big economic downturn. They're not going to cut rates because they just want to. It's going to take something severe that goes on. And when you look at this, the data of this money just absolutely dropping as far as the supply goes, well, that says that some economic disturbance of some significance is coming and maybe not that far out there. All of this talk of a soft landing just doesn't make sense when the Fed has moved interest rates up at a record pace. And now we're in QE and the money supply absolutely crashing at record levels. That says that there is trouble out there. And of course, what's bad for that is really bad for earnings. You got a deep recession, earnings are going to collapse. And that's not good for the stock market. You know, we've been bullish on the stock market. We've thought that this was going to be a good year, that the market would go up. We talked about in the beginning of the year that 2023 would be a bull market year. And we also said that the period September, October would be a corrective period. And all of that was very much online. And the last part of that is we thought the market would be firm in towards year end. It's followed our patterns just remarkably so. Then within this big upside move, or part of this big upside move that we've seen in the market, we thought it existed within a secular bear market. So that's a lot of information that I just gave you. Yes, we think we're in a bull cycle in a secular bear market. And this bull phase that we're in, it looks like it has some more time to go. But I think that all-time highs are going to be very tough to achieve. And everybody who's a bull thinks that, well, the cycle is that, well, the Fed will start to ease and interest rates will go down and then the market will go up. But that's really not what happens. The Fed, when they get aggressively easing, it's because the stock market is going down very sharply. And that's possibly what we're going to see out in 24, out in 25. The bond market may actually be giving us a surprise coming up soon, and I actually think that interest rates are going to have a pop coming into Q1. I'm going to show you that chart coming up as we look at the TNX chart in just a little bit. But one more important thing to consider as this market is strong right now is that when you look at NVIDIA earnings were off the charts. They were just absolutely amazing. And the stock has fallen since then, these last couple days. That just tells you that the tech leaders have a lot priced in already, and that it's going to be very hard for the market to make a lot of upside gains, at least for now. So I'm going to show you that we're looking for the potential of some additional on the upside. But I think there's risk in Q1. And I'll show you why as we get to that a little bit later in the show. For the week, stock market indexes up again, less than 1% though. Bond market, small losses. It was a very quiet week in most of the markets, but the bond market was pretty choppy. TNX, the 10-year yields, up about 4 basis points. And the gold market gains about $16. Silver just ripping to the upside here on Friday, and that had its second very good week in a row. I think there's actually risk for a little bit of a pullback in the metals markets in the next week, but I think there is sizable upside potential after that. And I have been buying silver miners, so I think it's getting to be that time. So just want to put that out there. The dollar, small loss, and I think on the short term, which we've been bearish now on the dollar, it still has room to go, maybe to about 102.5 in coming weeks. Oil, small gains, but a very choppy week. It had a very bad down day and then started to come back. It seemed like the market didn't like the fact that there was a deal between the Hamas and Israel to do a swap, a prisoner swap. So they sold gold on that news, but then it started to rebound after that. I'm sorry, sold oil after that. And we actually negative on oil, but very bullish, of course, on the gold market. We think that oil market in early 24 is going to give a fake out, get somewhere up around $80, but then a lot more risk and maybe heading again into the low 70s or worse. That is the opening here for the stock market for my opening comments, and I will have a lot to show you going forward. I want to make sure that you go to our website, askSlim.com, look around, explore, and share what we do. Make sure you tell other people about us. If you're new, you can get acquainted, and you can get our SIR Lite for free. Just go to the website and sign up for that, and you'll get stock market analysis, the S&P 500, daily sent to you. And I think you'll enjoy that. A good way to get started seeing what we do. On YouTube, subscribe to our channel, click the notification bell, and like this video. Give it a thumbs up. On X, follow us at askSlim. Questions you have about all the things that you're going to be seeing moving forward or anything I've talked about, please write to Matt at askSlim.com. Just quickly, this is our Black Friday deals. This is all askSlim product and just amazing stuff. What ways for you to really improve who you are as you engage in the market. This is only available through 11/26. That's Friday, Saturday, and Sunday. So make sure that you take advantage of these deals. If you're new, you're going to love our level one, especially if you're interested in the stock market. Save 50% on the first month. Now only $10. You can take the 5 essential building blocks of successful trading and save 50% on that. Now, this is an amazing workshop that I did. It looks at so many important things about being a trader and wraps that all in the psychological aspects of trading. You're just going to get blown away by what you learn in here. Lots of processes, talks about my history. 50 years now that I've been a trader, and it tells you the things that I've gone through to really learn how to up my game as a trader, as a mature trader. And the cycle analysis workshop, you'll just get 3 more days to get the $400 discount, and there are $400 in bonuses in there. So it's just an amazing deal. So take a look at that. And our new day trader service with our impulse monitor and Matt's roadmap of price zones. You're just not going to believe that grid and all the information you get, how to get on the right side of the market for day traders. 30% discount on that for the first month, $24.50 for that. So please go to askSlim.com and click that Learn More button. Questions right to Matt at askSlim.com. This is only for the 24th, 25th, and 26th, this Black Friday weekend. Please do take advantage of that. This is a trade idea. RV is one of the experts in the world in cycle analysis. He's looking at floor. It's bullish, and he's going to show you how to raise your odds of success by using the style of analysis that we use here at askSlim.com. Take it, RV.
This is an askSlim trade idea video walkthrough for a short-term long in Floor Corp. That's symbol FLR. Let's go ahead and pull up the intermediate term cycle analysis. What we see here in Floor is, first off, you want to note that this is right near 52-week high, so showing some very nice relative strength versus the overall market. And what's also happening is that this is also forming a right-hand translation. With this whole cycle rallying right here, it has left a short window of time for a pullback. That's that sell-off, and now we are poised for a move back through swing highs, which are at 38.87 here in FLR Corp. On the upside, we are looking for a move into this zone on the intermediate term from 40.41 up to 42.70. And that is only valid as long as we are holding above this rising 78.6 fib at 33.66. If we go ahead and shift over now to the daily time frame, what you'll see here in Floor Corp is that there are these longer money flows that are in play here. And what is happening is that I like that this has moved up post earnings, formed that higher low flag, turned up, and has now made a slightly higher high and is consolidating into a higher low. That is really very important because it is indicating that we are in a short-term uptrend. Right now here in floor, we are looking for this zone to hold from 36.88 to 36.35. This needs to hold above on a closing basis 35.81 for this long idea to be valid. And we are looking for this to rally up into this zone from 38.88 to 40.18. The overall risk on this idea is fairly nominal, right around 102. We are looking for a move of at least 206 here on the upside in FLR. If you would like to get more trade ideas, please go ahead and check out our Give the Gift offer that we have this year as our year-end special. This is really one of the best offers we have ever given. So if you are interested in learning more, please head over to askSlim.com and click on the special. Thanks again and have a great day.
Stock market analysis and projections on the S&P 500. Please look at this important information. It tells about our approach to the market and analysis and how you use it and adopt it into your trading. Announcing the askSlim holiday specials for 2023. Black Friday deals. I talked about those in the beginning of the show. You can go back and look at that in detail. I'll show you that quickly. And give the gift of askSlim. This is just fantastic stuff. You can learn more or sign up by going to the askSlim website up on the top, askSlim.com. And for more info, write to Matt at askSlim.com. And watch for announcements that we'll put up in X. Here's our Black Friday deals that I talked about in the beginning of the show. You can look for details on these by going to askSlim.com and click Learn More area, and you'll get some details on these, and you can sign up. This is our Give the Gift of askSlim for 2023, starting today. These are amazing. These are special rates, 3-month memberships, non-recurring. That means you can give the gift to someone who you know loves trading, and they won't have to resubscribe. It won't automatically renew. They can just get 3 months of amazing teachings that we bring and learn so much more about trading. You can give the gift to someone you know who loves technical analysis because that's what we teach, or give the gift to yourself. Great for first-time members or people that want to upgrade, because you can upgrade also and use these gifts and then just go back to your regular membership if you want to. So it's a great way to try higher levels. Excuse me. And a bonus gift for you. Imagine this. You're going to give these gifts. You're going to let yourself or other people benefit from the work we do, and we're going to give a gift back to you. If you take the level 2 holiday offer for yourself or for anybody else, it's only going to be $114.75, and that's $38.25 a month. That is an amazing deal. And we're going to send you back a $20 Amazon gift card. If you take the level 3 special holiday offer, 35% off, that's $232. That's only $77.33 a month. That includes so much you won't believe it. Of our charts, our market condition monitor, so many of our teachings, Discord access. I mean, there is so much in there that you can get. So it's only $232 for 3 months. Remember, non-recurring. And we're going to send you back a $50 gift card for Amazon. And level 4 special holiday offer. you're going to get 35% off. That's only $303.75. That's $101.25 a month. You're going to get our live charts that you can have also, and the pro version of the market condition monitor. Just fantastic things in there. $303.75, and we're going to give you back a gift, a $100 gift card from Amazon. It's fantastic. It has so much of our work here. You're also going to get our proprietary study, Slim Ribbon PO, market condition monitor, option bias indicator, reversal scout, all of those things that you see used, that us use, that really helps you. You'll now be able to have that live on the Thinkorswim platform. Just a absolute great way for you really to up your game. All of that, remember, non-recurring membership. So after 3 months, you can just decide you want to renew. That's great. You want to go down to your original membership. If you've upgraded, that's great. We make it so easy for you. So sign up or learn more. Go to askSlim.com or write Matt at askSlim.com. Take advantage of these fantastic holiday specials. Stock market, S&P 500. We're going to look at interest rates first, and there may be a surprise ahead. You're going to get an idea of the cycle analysis, and then we'll look at the S&P 500 intermediate and short-term analysis, and I think you're going to find this absolutely illuminating. Let's take a look here at TNX. This is a weekly cycle chart of TNX. Those of you that are brand new, these arches that you see on the bottom are half moons. These are called cycle brackets. This is how we see the repeating rhythms in the market. Cycles move from trough to trough, and there are repeating time frames. You can see the energies as money moves in and money moves out. It's the way that we see money flow. You can see that in there, and we get more and more information as these formations occur. You can see when you get a bullish cycle like this, the odds are very high. You're going to get another bullish cycle just like this. When it fails and isn't, after some significant time frame, able to make the high, you usually end up coming and taking out the low. So you see that you get corrections in these phases: rising phases, peaking phases, declining phases, and bottoming phases. That's how we see these. We also use the reversal scout on here for momentum, and we use a reversal scout or the slim ribbon for momentum, slim ribbon PO. Those are all our indicators, and we also look at here at a 13 and 34 week moving averages. We don't look at the 50 and 200 or 100 like other analysts do. We have our own way of looking at this. When the reversal scout is positive, turns positive near a bottom, near that trough, it tells us it's likely to keep rallying until it tells us that it's in a corrective mode. And we get that information. You could see what happened here. And this was we labeled this that it was very likely a cycle peak when that was made in there. And now you can see that interest rates look like they're going to come down into December, into January. These two blue lines show you that it's about the third week of December to the third to fourth week of January is the range of time that this trough is likely to come in. It tells us that interest rates are likely to fall. Those of you that watch me on a regular basis, or RV, we talked about that it was likely we were going to test 440 yields. And you can see we've done that, got under 440 yields. And actually, this looks like into this December-January period, it could get as low as 424. 4.24 yield. That means that there would be a rally in the 10-year or rally in the treasuries to get the yield down. So that, based on the way the stock market is acting, the stock market likes the lower yields right now. The lower yields, when they move down sharply because the stock market moves down sharply, that's a different case. But in this case, the higher yields were choking the markets, and it was giving an indication that the huge demand from the government was going to keep yields high. And now, with this momentum turning over in this period of the next 4 to 6 weeks, excuse me, looking like yields can stay soft, that says to us that we'll probably have a period in the stock market where the stock market can pretty much remain on the firm side. Now, when you see this period right over here, and this is the key thing we're looking at right now, is that out over here in late January, February, and March, it looks like we're going to be in a new rising phase. So if yields are going to be going up here, it must mean that the Fed is going to maybe at that time be saying, well, it's not really time to be cutting rates yet, or maybe inflation numbers will be ticking up again. Something is likely to happen out over here to scare interest rates back up for one more blip. And the analysis on the 10 years or on the Treasury says that they're likely to fall and test recent lows into this period out here into March or April. That says that yields are likely to be rising again, and that isn't necessarily very good for the stock market based on how they're trading right now. Present correlation. So we're looking at 10-year yields right over there, and even though this is likely a cycle peak in the yields, it is very probable that it's going to get tested out over here, and that we could see 5-year yields again on the 10-year out here in this March-April period. Not many people are saying that, but I think this could be a surprise that actually gets the stock market into a correction. Now let's switch over to the S&P 500 and take a look at that timing. So in here you could see the cycle action that we're looking at, and the market we believed would be in correction, and you could see where the momentum turned over here in this yellow zone. This was the period of risk that you could see that we had labeled right in there, and the expected softness starting in August and down through October. We had that pretty much nailed. We thought it could get to 4,100. We thought 4,200 could hold it over here. 4,100 was a pretty good shot, and we saw it fell about 10.9%. And we thought that the daily chart would give us a low in late October, and that's exactly what happened. You can see the cycle rhythms that are in here. This is a harmonic family, and you can see the half cycles that are in there and the half cycle right in here. And that next half cycle comes down over here into this January period. And then out over here into that period of April and May, March, April, May, where I showed you that yields are likely to go up, you get into that next period of risk over here. So what does that tell me about the stock market? Let's get a little closer look in here so that you can see how these line up. Right over here in this period, this is a tough spot. Now, we had a repair level right there. We thought if it got through 4,500, it could get to 4,607. Back to that peak, back to these key resistance areas. There's a fib extension right in there and that cycle peak resistance. It could still get up over here to 4,607. I have no problem with that possibility. Also, there's a key number out over here at 4740-ish. That is a possibility, probably more likely if it would happen here before this decline that begins sometime in February or March that comes down into this April period. So there's a possibility that this would be a stronger move out over here to that level right there before it turned down, or there's a possibility that that 4607 level, I'm just going to duplicate that, comes out over here, out into the summertime, spring and summer into next year. So we're kind of looking, and I said that this analysis was going to be intermediate out for a few months. There is a possibility we get over 4,700, but the possibility of getting back to that 48 and change to all-time highs, I think, is extremely low. So I think ultimately what we're going to be in is a pretty wide choppy period. This correction right in here that we're looking at, and I'm going to get closer again for you to see right like this, points to it getting down to potentially the 23.6%, which is right around 44.60. That's not much of a corrective period in here. More likely this period out into January, so a peak somewhere out over here in December, come down into January to about 43.90 and then begin to move up again. This becomes a buy zone right over here. But this says that we're likely to be in a choppy period in here. We'll call it 4607 down to about this area of 43.90-ish, 43.95 over coming months. This could be all the way out here into this March period before it gets into this bigger period of risk, with an outside chance of one of these rallies taking you up to 47.50. I have doubts about this, especially when we have NVIDIA come out with fantastic blowout earnings and the stock go down. I mean, it really says that the tech stocks have priced in the move, and that it's more likely that we're going to see the retails, which the numbers really look like they're projecting to be really bad, out for the Christmas season and moving forward. Those kind of stocks weighing on the market, and the tech stocks giving ground in here because they are way, way priced. There's so much baked in the cake in them. In that Magnificent Seven, that it's likely we're going to get into corrections. I'm not showing you the NASDAQ today. Remember, you can get our full analysis on the S&P 500, NASDAQ, and the Russell, all of those indexes, by becoming a level 3 or 4 member. And level 4, of course, gets them live on the Thinkorswim platform just by downloading our charts. So again, we're looking at a range in here. 4706 is pretty likely. Coming down and correcting into this area under 4400 is pretty likely. 4390-ish or something like that over this next couple of month period, and then maybe widening out the range out over here. And then the next bear market we'll start talking about sometime after that period, the next cyclical bear market, because I already think we're in a secular bear market right now. You can watch our big picture analysis at the beginning of the year or in the middle of the year to see my big picture analysis showing the secular bear markets, or you can wait till the beginning of the year when I publish that for the public sometime out in January. Our members will get that probably around the end of December or the first week of January. So this is the intermediate look right over here. Where we're expecting range trading to begin fairly soon, maybe a little more on the upside that we have in here, 1.5%. That may be the best of it that we see here in the near term. Take a look now as we look at the daily charts, and again, you'll see the magnificent cycle analysis that's in here. Take a look at these rhythms in the market. You could see the harmonics on the bottom, and then just look at, let me just get my pointer. I don't have my big red pointer today. You can see the rhythm in here, the half cycle, the half cycle, half cycle, half cycle. And look at that. Each of these minor cycles give you the declines right in there. And when they're joined by the bigger dominant ones, they are bigger declines. So where are we right now? Well, we're in a period like this right here, where you're likely to get a minor pullback on that powerful upside move. That's somewhere right in here, and then moving up to the upside again. So this is the short-term view that we're looking at right now. And what we see in here is that we have a powerful cycle in here. You could see the slim ribbon right here where it turned positive, the slim ribbon PO turning green. It's so powerful, it can't even get to an area where it gives you the upside arrow signal because there's no selling in here whatsoever. We're looking for minor selling in here. That 23.6% at about 44.50. That is a reasonable pullback over the next week or week and a half. The trough period is December 1st to December 11th. So somewhere in there, we're looking for a pullback and a bottom and then moving up again. Again, this is that 4607 area that it's pointing to on the daily chart. And you can see that signal, that warning right there. It says that if you got through that red line, the 76% repair level, it warns of the test of the 4606 peak, and that's this level right over here. It's also a major fib extension. So 4606, 4607, so it depends on which one's lining up. That's where we're projecting, either now or a pullback and then getting up there over here. No real risk that we see in the market right now. Momentum conditions powerful when you look at the slim ribbon right in here. When you look at the reversal scout here in the weekly, powerfully moving up, only 4 weeks into this advance off of this trough. What you get is only minor corrections under those conditions. And therefore, the cyclical bull market we're in has life. And pullbacks, if we get them here as expected into January, are going to be buying opportunities for more on the upside. That is my extended look comparing interest rates, which we see the surprise ahead, where we think we're going to see an upside bump in interest rates, maybe testing 5% again in Q1, and then bringing that correction we're looking for in Q1, potentially down into April, and that could be a pretty sharp correction in the stock market during that period. That is it. Don't forget to look at the specials that I showed you, so many of them, as far as Black Friday and as far as the opportunity to give the gift of askSlim. If you haven't watched that, go back and look at them. They're fantastic. Go to our website and sign up for SIR Lite for free if you're just starting out. Click the notification bell and give us a thumbs up if you want to watch this on YouTube or know when our videos are posted up there. And you can watch a bunch of our member videos in playlists. On X, follow us at askSlim. Any questions you have about the fantastic stuff that I have shown you in this show, write to Matt at askSlim.com. That's it. I want you to be so unbelievably careful because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show.